You know, when most people think about real estate investing, they picture finding a cute house, maybe putting a tenant in it, and then just waiting for a rent check to magically show up. They see it on TV, this idea of passive income, where you just buy a property and it makes you rich. Well, that's the amateur view, and frankly, it's a dangerous one. Professionals, the ones who build serious, generational wealth, they see real estate completely differently. For them, it's not about the color of the paint or the kitchen countertops. It's all about the economics. Let's dive into this, because what they see isn't a house at all. They see an economic machine.
And this, right here, this is the fundamental shift in perspective. On the left, you've got the amateur. They're driven by emotion. They see a home, they fall in love with the backyard, they get attached, and they hope its value goes up. Their entire strategy is built on hope. But on the right, you have the professional. They're driven by pure, cold discipline. They don't see a home, they see an equation, a system of inputs and outputs. They aren't buying a property, they're acquiring a machine built for one single purpose, to generate wealth. Emotion has been completely stripped from the process.
And look, the machine itself is actually beautiful in its simplicity. It really only has three fundamental parts. First, you use debt. You leverage the bank's money, not your own, to control a much larger asset. Second, you trade that borrowed money for a physical asset, the property. And third, you place a customer, your tenant, right in the middle of it all. Their rent payments are the fuel that makes the whole machine run. That money services the debt and hopefully generates a profit. Now, when this machine is built correctly, based on sound math, it is one of the most powerful wealth creation tools ever invented. But if you ignore the economics, that same machine can turn around and eat you alive. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
All right, so here's the game plan for today's masterclass. First, we're going to really define the machine itself. Then we'll dive deep into mastering the financial spread. That's the engine that makes it all run. We'll look at why so many of these machines are breaking down in today's market, and then, this is crucial, how you can actually manufacture value to fix them. We'll also cover how to use inflation to your advantage, and we'll end with the single most important rule of all, the discipline of math.
Okay, let's kick things off with Section 1, the real estate machine. We've talked about this machine in the abstract, but let's get concrete. The fundamental model is what we just laid out. Debt, asset, customer. It seems simple, but its power is only unlocked when you truly, deeply understand the economics behind it. You have to know how the gears turn, or I promise you, they will grind you up.
And that leads us right into the most important part, Section 2, mastering the financial spread. I want you to think of the spread as the engine of your machine. It's not just a part of the system, it is the system. Every single real estate deal that has ever worked or failed, from a tiny house to a skyscraper, it all runs on this one single concept. Getting this right is what separates the real investors from the gamblers.
So what in the world is the spread? Well, it's pretty simple. It's the difference between what it costs you to borrow money and the return that money earns you from the property. It's a form of arbitrage, really. You're profiting from the difference in the price of two things, the price of money and the return from the asset. If you can master this one variable, you've mastered the entire game of real estate investing. It's that important.
Let's break that down, because it really comes down to just two numbers. You have your input, which is your cost of capital. See, professionals rarely use all their own cash. They use OPM, other people's money, usually from a bank. And that money has a price tag, the interest rate. Then you have your output. That's the return on investment, the ROI. The property produces income, and the return it generates is its yield. The whole game, the entire business, is just managing the relationship between these two numbers. That's it.
So when you get it right, when your output is greater than your input, when the money your asset earns is higher than the cost of borrowing that money, you achieve what's known as positive leverage. And that is the holy grail. It's the entire point of this whole exercise. It means you are literally making a profit on money that isn't even yours. You're earning a return on the bank's money, and that is how real wealth is amplified.
Okay, let's put some real numbers to this with an example from just a few years ago. Let's say you could borrow money from the bank at a 3% interest rate. That's your input, your cost of capital. Now, you take that borrowed money and you buy a property that produces a 6% annual return. That's your output. The difference between those two numbers, that positive 3%, that's the spread. And that is pure profit you are earning on borrowed funds, just for structuring the deal correctly. I love this analogy because it makes it so clear. A positive spread is like being offered the chance to buy dollar bills for 94 cents. If I made you that offer, how many would you buy? You'd do it all day long, right? You'd buy as many as you could possibly get your hands on.
That is what a properly functioning real estate machine feels like. It's a simple, profitable arbitrage that you can just execute over and over again to build wealth.
But of course, it's not always sunshine and rainbows, is it? We need to talk about what happens when the machine breaks. This is where fortunes are lost. This is where bad deals are born. And it's all defined by one very dangerous concept that is unfortunately running rampant in today's market: negative leverage. So the question is, what happens when the math is completely inverted? What happens when your input, the price of money, is actually higher than the return from your output? This is the critical situation so many investors are finding themselves in right now, and the scary part is many don't even realize it's happening until it's far too late.
What you get is something called negative leverage. And let me tell you, this is a catastrophic failure of the machine. It means that for every single dollar you borrow from the bank, you are guaranteed to lose money. From the moment you close the deal, it's a slow financial bleed. You're in quicksand, and it's draining your personal finances every single month instead of building them.
Now look at how this mirrors our last example, but with today's numbers. Right now, a bank might want 7% interest for their money. That's your input. But because property prices are still so high, many assets are only producing a 6% return, maybe a 6 cap. Now stop and think about that. You are borrowing at 7% to earn 6%. The spread is now a negative 1%. You are literally paying the bank for the privilege of losing money on your so-called investment.
And this isn't some theoretical number on a spreadsheet. This has devastating real-world consequences. I talk to people every single day who are buying properties that are negative $300, $500, even $1,000 a month out of their own pocket. Think about that. They have to go to their job, work 40 hours a week, get their paycheck, and then immediately write a check to their supposed asset. Their asset has become a very expensive liability.
And this is the great lie investors tell themselves to sleep at night. They'll look at a deal with completely broken math, a deal that's bleeding cash every month, and they'll say, oh, it's okay. The market always goes up. Appreciation will save me. This is one of the most dangerous phrases in all of real estate. It's the mantra of a gambler. Let me be perfectly clear about this. Relying on market appreciation to fix a deal that is losing money from day one is not investing. It is gambling, period. You are speculating. You're betting on an outcome you have zero control over instead of buying based on the proven, predictable economics of the asset today. You do not buy real estate to fund a monthly loss. You just don't. If you're finding this valuable, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. So, if the market isn't just handing you deals with positive leverage, what do? Do you just quit, sit on the sidelines and wait? Absolutely not. You don't wait for the market, you manufacture the economics yourself. This is Section 4, How to Manufacture Value. This is where you actively force the machine to work for you, and it's how the pros make money in any market cycle. This whole process is called a value-add strategy. You buy a property based on its current, maybe even underperforming operations, not on hope. Then you execute a business plan to improve it. You can renovate kitchens and bathrooms to command higher rents. You can add in-demand amenities like washers and dryers. You can fire bad property management and bring in a team that actually collects rent on time and gets your vacancy from 10% down to 2%. You can audit the expenses and cut out the waste. You are actively, physically forcing the property's returns higher to create the positive spread the market wasn't giving you. Let me walk you through a real-world case study to make this really hit home. This is a classic value-add strategy that has been used to create millions of dollars in wealth, and it's deceptively simple. We'll just call it the washer and dryer play. Okay, so the logic is super straightforward. Step 1, you act like a detective. You identify an opportunity, a 200-unit apartment building where every single unit has the hookups for a washer and dryer, but none of them actually have the machines. That's a huge clue. Step 2, you make the investment to purchase and install 200 sets. Step 3, as each tenant's lease comes up for renewal, you offer them this brand new amenity and you raise the rent by, say, $75 a month. They get a huge convenience, and you improve the asset's performance. And step 4, that's where the magic really happens. We calculate the new income. So 200 units times $75 a month, that's an extra $15,000 in new monthly income. Annually, that's an additional $180,000 in pure profit hitting the bottom line. But wait, it gets even better. In commercial real estate, a property's value is based on its income.
At a 6% cap rate, that $180,000 in new income you just created, that added $3 million to the property's value. We didn't wait for the market. We took a mediocre deal, and with a clear, strategic plan, we manufactured a great one.
And this illustrates such a crucial point. Real estate rewards good operators. The person who solves the problems, who improves the property, who responsibly raises rents by improving the product, they are the ones who win. This is not passive income. This is a business, and the people who treat it like a business, with real systems and strategies, are the ones who build lasting wealth.
Now let's move on, because there's another invisible force that pushes this machine forward over the long haul. That brings us to Section 5, using inflation to win. Now, most people see inflation as this terrible thing that just erodes their savings. But for a real estate investor with long-term fixed-rate debt, it's one of the most powerful tailwinds you could ever ask for. It's like having a secret partner working for you 24/7.
Here's the key idea you have to grasp. When you take out a 30-year fixed-rate loan, you are effectively shorting the US dollar. That's a fancy way of saying you're betting against it. You're locking in a debt today that you get to pay back over the next 3 decades with future dollars that will almost certainly be worth less, all thanks to inflation. And historically, that has always been a winning bet.
This slide just visualizes that incredible long-term effect perfectly. Look at year 1. Your fixed mortgage payment is $2,000 and the rent you collect is $2,500. Your cash flow is $500. Now, let's fast forward 10 years. Your mortgage is still exactly $2,000. It is frozen in time. But because of inflation and demand, the rents have probably risen to $3,200. Your cash flow has more than doubled to $1,200 a month without you lifting a finger. By year 20, it's over $2,000. And by year 30, the mortgage is gone, it's paid off, and you're collecting the full inflated rent as pure profit.
This growing gap, this ever-widening space between your fixed debt payment and your rising income, that right there is where true long-term generational wealth is created. Your single biggest expense is locked in stone, while your revenue and the value of your asset continue to climb with inflation. This is how you make inflation your employee, not your enemy.
And this all brings us to our final and by far most important section, the discipline of math. This is the final unbreakable rule that governs everything we've just talked about. It is the bedrock foundation upon which every single successful real estate portfolio in history has been built. It's the one thing you can never, ever afford to forget.
And here it is, the core thesis of this entire explainer. If the economics work, you buy the property. If the economics do not work, you walk away. It is that simple. It doesn't matter how much you love the kitchen. It doesn't matter what you think the market might do next year. There can be no emotion. There can be no hope. There can be no gambling. There is only the math. The numbers tell you the story, and you must have the discipline to listen to them.
So I'll just leave you with this one final question to think about. When you look at your next potential investment, are you leading with emotion or are you leading with math? Are you hoping or are you calculating? Your answer to that question will determine your entire future as an investor. To put all of this into practice, don't forget to like, share, and subscribe. And of course, check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.